The late 1990s witnessed a technological revolution. The internet, once a niche technology, was rapidly entering homes and businesses. This digital frontier promised to change everything. It was the dawn of e-commerce, online communication, and a new era of business. Investors and entrepreneurs alike were captivated by the potential of the internet. The possibilities seemed endless. Companies with a.com in their name, regardless of profitability, attracted massive investments. The stock market, particularly the tech-heavy Nasdaq, soared to unprecedented heights. It was a time of unbridled optimism, fueled by the belief that the internet would rewrite the rules of business and finance. The dot-com boom was driven by a potent cocktail of speculation and hype. Investors, both seasoned and novice, were caught up in the frenzy. Valuations soared to astronomical levels, often detached from any underlying fundamentals. Companies were valued not on their profits, which were often non-existent, but on their potential to disrupt traditional industries. This speculative bubble was further inflated by the media. Stories of overnight millionaires and tech wunderkinds dominated headlines, fueling the public's appetite for internet stocks. Investment decisions were driven more by emotion and herd mentality than by sound financial analysis. The market, it seemed, had entered a state of irrational exuberance. The dot-com bubble, like all bubbles, was unsustainable. By early 2000, cracks began to appear in the facade. Interest rates were rising, making it more expensive for companies to borrow money. Many dot-com companies lacking viable business models began to falter. The warning signs were there, but few heeded them. On March 10, 2000, the Nasdaq Composite Index peaked at 5,132.52. The bubble had burst. What followed was a precipitous decline. Tech stocks plummeted, wiping out trillions of dollars in market value. The dot-com dream had morphed into a financial nightmare. The collapse of the dot-com bubble left a trail of financial devastation in its wake. Countless internet companies, once darlings of Wall Street, went bankrupt. Pets.com, a poster child for the excesses of the era, famously shut down after just 268 days of operation. The company, known for its sock puppet mascot, had spent millions on advertising but struggled to turn a profit. The fallout wasn't limited to startups. Established companies like telecom giant WorldCom were also caught in the crossfire. WorldCom's collapse, revealed in 2002 as a massive accounting fraud, further eroded investor confidence. The dot-com crash served as a stark reminder of the perils of speculation and the importance of sound business fundamentals. Section 5. Lessons learned, the importance of sustainable growth. The dot-com bubble, while painful, offered valuable lessons. It underscored the importance of sustainable business models, sound financial management, and, a healthy dose of skepticism. Investors learned the hard way that not all that glitters is gold. The crash separated the wheat from the chaff, paving the way for a new generation of tech companies built on more solid foundations. Companies like Amazon, Google, and eBay, while also caught in the downturn, weathered the storm. They had solid business models, strong leadership, and a focus on long-term growth. The dot-com crash served as a crucible, forging a more resilient and sustainable tech industry. Section 6. Echoes of the dot-com bubble. A new era of speculation? Over 2 decades after the dot-com crash, questions linger. Are we witnessing a repeat of history? The rise of cryptocurrencies, NFTs, and the metaverse has sparked both excitement and concern. These emerging technologies hold immense promise, but have also attracted speculative fervor reminiscent of the dot-com era. The valuations of some tech companies today, particularly in the software and social media sectors, have raised eyebrows. Are these valuations justified, or are we witnessing another bubble inflated by hype and speculation? The parallels to the dot-com era are undeniable, prompting calls for caution and a return to fundamentals. Section 7. The siren song of AI and crypto, a call for vigilance. Artificial intelligence and cryptocurrencies are transforming the technological landscape. AI is poised to revolutionize industries from healthcare to transportation, while cryptocurrencies offer the promise of decentralized finance. However, these technologies are not without risks. The potential for disruption is real, but so is the potential for hype and speculation. Investors must approach these emerging technologies with a critical eye. Understanding the underlying technology, the regulatory landscape, and the long-term viability of business models is crucial. The allure of quick riches is tempting, but history has shown that such gains are often fleeting. Section 8. Navigating the tech landscape, informed investment in uncertain times. The tech industry is characterized by rapid innovation, disruption, and volatility. Navigating this landscape requires a blend of enthusiasm and caution. Investors should approach tech investments with a long-term perspective, focusing on companies with strong fundamentals, experienced leadership, and a track record of innovation. Diversification is key. Spreading investments across different sectors and asset classes can mitigate risk. It's also crucial to stay informed. Understanding market trends, technological advancements, and economic indicators can help investors make more informed decisions. Section 9. The future of tech: balancing innovation with prudence. The tech industry will continue to evolve, disrupt, and reshape our world. Innovation and entrepreneurship remain essential drivers of progress. However, the lessons of the dot-com bubble should not be forgotten. Balancing the excitement of new technologies with financial prudence and a long-term perspective is crucial for sustainable growth. The future of tech is bright, but it's up to investors, entrepreneurs, and policymakers to ensure that the mistakes of the past are not repeated. By embracing innovation while heeding the lessons of history, we can harness the power of technology to create a more prosperous and equitable future.